Hello, and welcome to the 9th episode of Season 3 of the Dark Money Files, in which we shine a light into a murky world. I am Ray Blake, and with me is my co-host, friend and business partner, Graham Barrow. Hello, Graham.
Hello, Ray.
Last time, Graham, we focused on PEPs, politically exposed persons, and we described them as those people able to exploit their public position to influence the flow of public money, assets or contracts.
Yes, either to their own benefit or the inappropriate benefit of others.
And by others, of course, we mean their family, friends and close associates.
It's worth stressing, Ray, that being regarded as a PEP implies no belief that the person is corrupt, simply that they are in an advantageous situation if they were corrupt.
That's a good point, Graham. Let's say then that we've identified a PEP or two in our client population, as well as some relatives and close associates of PEPs. Some we have personal accounts for, others own companies or have established trusts where we're the bankers.
And I'd say that's the case for most banks to some extent.
Yeah. So what controls do banks have in place to manage the additional financial crime risks in those situations? We spoke a little bit about this last time, but let's be comprehensive today.
Yes, so, at the outset of the relationship and periodically during it, the bank would need to apply Enhanced Due Diligence, or EDD.
Now, EDD is one of those concepts that you instinctively believe should be unambiguously defined somewhere, so there's a common understanding of exactly what it requires.
Yeah, that would be lovely, Ray, but then it wouldn't be risk-based, would it?
No, Graham, it wouldn't, which means that banks to an extent have to take a view. What the legislation does require, at least in Europe and jurisdictions that most closely adopt the FATF recommendations, is that steps are taken to understand the source of wealth of any PEP. And as we saw last time, there's a movable degree of vigour we can apply there depending on the specific risks that we perceive.
That's absolutely right, Ray.
On the horizon, forthcoming EU laws will be more prescriptive on actual EDD measures that must be applied. So banks will be looking to align to those as the national legislation is published. But we don't have that now. So what does EDD typically look like now beyond source of wealth?
Well, bear in mind that EDD applies not only at the outset of a relationship, but that there is also a requirement to periodically review the relationship and refresh due diligence regularly.
How regularly, Graham?
Well, I'm glad you asked me that, because it is just about the same period or length of time as a piece of string.
By which you mean there's no fixed requirement.
That's exactly right, Ray. The one near universal feature of approaches is that the higher the risk, the more frequent those reviews. So your highest risk cases might need a periodic review every year, or perhaps even every few months, whilst there may be a couple of years or longer between periodic reviews of lower risk cases.
So what's the purpose of a periodic review, Graham?
I know what most people would say, Ray.
Well, so do I, Graham. Most people would say it's to check whether anything has changed in the client's circumstances.
Yes, they would. And what's wrong with that, Ray?
Well, if something changes, you should be considering it immediately, not waiting until the review.
And that's exactly right, which is why we have event-driven reviews. When some aspect of the client's behaviour or circumstances indicates a possible alteration in the risks the relationship brings, we should be immediately undertaking a review.
Now, why doesn't that tend to happen often, Graham?
Well, you're right, often it doesn't. Many firms don't have the right systems to easily detect these changes on a day-to-day basis.
So where the ownership of a company changes, or where the client moves to another country, or where they change occupation or business, We need to have such a review, but there's not an easy way to identify that the change has actually happened.
That's true, and firms are generally putting the onus in their terms and conditions on clients to advise them of such changes. But this doesn't always lead to the client behaviour you might expect.
Well, I shudder to think what terms and conditions I've signed up to in the past few years without reading them, against which I'm almost certainly delinquent.
Well, indeed. And so that event-driven review is not just to update our paperwork, Ray. That's part of it. But we need, in any review, to consider again the risk the relationship represents in the light of the new circumstances, but together with any changes in the bank's own risk appetite or its assessment of risks more broadly.
That's a good point, Graham. Well made. In fact, it could be the case that the change has turned the client from a low-risk client to a very high-risk one. And if there isn't a periodic review due for another 3 years, say, that's a long time to be unsighted on a big risk. We may have wandered slightly from the topic, though.
Remind me, Ray, what was the topic?
It was, what additional controls do we put in place for higher risk clients? Specifically, we were looking at PEPs before we look at other high risk situations.
Gotcha. So, we've talked about the requirement for EDD, part of which will be the source of wealth, and we've talked about the need for more frequent periodic reviews. There are a couple of other elements of EDD that are likely to be deployed, I think, as well.
I was thinking about UBO thresholds, for example.
Go on.
Well, this applies where we're looking for UBOs in a corporate entity. In most jurisdictions, we apply a threshold for ownership below which we don't have to identify beneficial owners.
Yes, and most often that's 25%, with some notable exceptions.
Indeed. Usually banks look at a lower threshold where the client is high risk, often 10%. But of course that throws up what you might call the PEP conundrum.
Oh, now what do you mean by that, Ray?
Well, let me ask you a question. If you're onboarding a corporate entity and you identify 3 beneficial owners who each own 28% of the company, do you need to look any further?
Well, assuming it's a standard risk-rated relationship, no.
Why?
Well, because together those 3 people own jointly 84%, and therefore no one else could qualify as a UBO.
But supposing that the other 16% was owned by a PEP, and you apply a 10% rule to corporate PEP relationships.
Well, then you would have to identify the 4th UBO and do EDD and everything else that goes with it.
But Graham, you just said we didn't need to look because at the point of the original identification of UBOs, you were only looking for those with more than 25%. You found 3 of them who weren't PEPs and then, quite rightly, in your view, stopped.
I see what you mean by conundrum now. So if you apply a 10% threshold for PEPs, but a PEP owns between 10 and 25%, and there are no other reasons to apply a higher risk rating, you may not discover their existence and then inadvertently breach your own policy requirements.
Exactly, and that's why some firms apply a 10% threshold across the board to avoid such an eventuality.
Oh, life can be complicated at times, can't it, Ray?
It certainly can.
Right, moving on. The 10% level, whether applied across the board or only to specific high-risk cases, is a common feature, in our experience at least, of EDD. Beyond that, I don't think there's anything specific that we can say is common to most firms. Different banks will and do different things.
Okay, so other than for PEPs, what other situations will require EDD, Graham?
The first general point I'd make, Ray, is that a certain level of client due diligence has to be undertaken for all clients. But this is a minimum level of due diligence, and firms are expected to do more where the circumstances dictate.
So that even if you're looking at a client your system defines as low risk, if there are elements of their situation that suggest further inquiries, you should make those inquiries.
Exactly.
And there are, at least in the European member states, certain situations that require EDD to be applied by law, aren't there?
Yes, Ray, there are all sorts of rules around high risk third countries, around non EU correspondent relationships, and frankly, there's quite a nebulous one about where a transaction is complex and unusually large, or there is an unusual pattern of transactions and there is no apparent economic or legal purpose.
And that last one is tricky because potentially you can have a lower risk client alerting on your transaction monitoring where you may have to make a SAR and scrabble around doing EDD at the same time in responding to that alert.
Yes, and there's also a requirement to apply EDD in all cases presenting, quote, a higher risk of money laundering.
Yeah, and there are a couple of lists of examples of factors that should indicate lower and higher risk, aren't there?
Yes, Ray, there are.
Okay, so can we go back to high risk third countries, Graham? Because the fifth anti money laundering directive that comes into force in January makes a big thing of these, doesn't it?
It certainly does, Ray. It makes certain actions mandatory when dealing with clients from or in these countries and for any transactions that involve those countries.
Can we clarify what a high risk third country is? We know firms that have over 100 high risk countries in their systems. Is that what we're talking about, Graham?
No, Ray, we're not, although they may be in that list, but the European Commission is tasked with maintaining a list of nations with strategic deficiencies in their national anti-money laundering and counter-financing of terrorism regimes that therefore pose significant threats to the financial system of the European Union. Right now, there are 16 countries on that list.
Okay, obvious next question, Graham. Which 16 countries?
Okay, if you want the full list, here it comes. It is Afghanistan, Bosnia and Herzegovina, Guyana, Iraq, Laos PDR, Syria, Uganda, Vanuatu, Yemen, Ethiopia, Sri Lanka, Trinidad and Tobago, Tunisia, Pakistan, Iran, and the slightly ironically titled Democratic People's Republic of Korea.
A bit of an AML rogues gallery there.
Indeed, Ray. The European Commission proposed some additions earlier this year.
Yes, I saw that countries like Ghana, Nigeria, Saudi Arabia, and some minor US territories were in the frame.
Yes, they were.
What happened, Graham?
Well, the European Parliament wouldn't approve the list. Evidently, but not particularly unsurprisingly, there was a fair amount of lobbying by Saudi Arabia and the US.
Well, why is that, Graham? I mean, after all, most firms will already be treating these countries as high risk, so what's the difference?
Ray, the difference comes with the fifth anti-money laundering directive, which makes it much more difficult for firms to do business involving these countries and sets mandatory requirements like additional EDD and senior management sign-off that makes it potentially uneconomical for firms to do such business.
I see.
And with this list of 16, firms cannot take into account any mitigating factors. They have to treat them as high risk.
Okay, I see. So if we take the example of a client based in what a firm regards as a high-risk country, the fact that you're only providing low-risk products and that the client is involved in a low-risk business might mean that you treat the client as medium or even low risk overall, despite the presence of a high-risk country, which in most cases is going to mean no EDD.
That's absolutely right.
But if the country is also on this EU high-risk third country list, there's no choice. That trumps all other measures and you have to treat them as high risk.
Yes, and you can imagine what that would do for the business models, especially of some regional banks.
Who could claim quite reasonably that they're much closer to and specialist in dealing with the local risk factors, but are being made to apply draconian controls the same as any international bank, which may have little experience or local presence in the area.
Yes, the presence of a particular country on that list is going to be a very major issue for some European subsidiaries of foreign banks in particular.
And this isn't the same thing as the EU's blacklist and grey list, is it?
No, do you want to talk about those, Ray?
Sure. These are the lists of nations the EU regards as non-cooperative tax jurisdictions. The blacklist is countries that have made no undertaking to the EU to clean up their act.
By which we mean to improve their tax transparency.
That's right.
And the grey list?
That's countries where the EU still have issues with their tax transparency, but the country has agreed to take measures aimed at meeting the EU's standards.
And those are entirely different lists to the high-risk third country list.
Yes, they are. The high risk in the high risk third country list refers to the risk of money laundering, not tax transparency.
Gotcha.
And I think on that point of clarification, we're probably there for this episode.
I agree. So what's coming up in the week ahead, Ray?
Hopefully a quieter one than last week, Graham. What with 2 Dark Money Files live events and all the news coming out of Sweden, it was quite hectic.
Yes, but in a good way. We had a marvellous turnout in London, didn't we? And wasn't it great to meet so many of our listeners in the flesh?
It was, and we'll definitely be doing more of these.
Yes. So, Ray, next week.
Well, I'm doing some client work, including what should be quite a fun speech for a bank's Financial Crime Week. You're off with the Rozzers, aren't you, Graham?
Well, I'm not sure they'd appreciate that. So, if by that, Ray, you mean I will be speaking at the Serious and Organised Crime Exchange Conference, then yes, Ray, I am.
Well, splendid. And a little bird tells me there's some more Swedish news due as well, in which you have a bit of a role.
Oh, possibly, if I'm not cut off and left on the editing suite floor. But yeah, I think that could be true. And hopefully we'll be able to talk about that in rather more detail in our next episode.
I'm looking forward to it.
Thank you for listening to this episode of the Dark Money Files. We hope you enjoyed it. If you would like to listen to future episodes, please subscribe through iTunes, Spotify, or your normal podcast provider. Thanks.